Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is generally a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. Also, I just let you have a look at the disclaimer. I'll just run through what we hope to get through in the next half an hour, 40 minutes or so. We'll follow the standard format, actually. So we'll look at how markets are currently shaping up after an absolutely huge week of risk events last week. Of course, we'll then review those main risk events, those being, of course, the FOMC meeting, the ECB meeting, and the Bank of England meeting as well, all last week, as well as some bits of data in there, including, of course, US CPI and other various data points. We'll run through those key meetings, those key three meetings, essentially, before then looking at the main events for this week. Quite a busy week, actually, before we get to the holiday period. So we do have the Bank of Japan meeting, of course. We have UK inflation data and US core PCE data, which is the Fed's favored inflation gauge. So a lot to look forward to still this week, as well as, of course, trying to digest what happened last week. Okay, let's just firstly go to we'll go to the S&P, actually, and just a general look at the markets at the moment. Really, the rally in US equities and bonds actually faded really on Friday. This is a weekly chart, but yes, that rally faded slightly. We had a pushback from the Fed and Powell's pivot really after last week's Fed meeting, of course. Fed members Williams and also actually Mester today in comments. Slight pushback against this expectation of rate cuts in the US. We'll look at that, of course, in more detail very shortly. That has really seen the sort of buy everything rally led by US heavyweight stocks, kind of questioned slightly in Asia and Europe today. Europe as well, not helped by today's poor German IFO, that's business data survey, basically, which points to ongoing recession risks. We also had on Friday PMI data, which continued really to highlight the divergence that we've seen in the US and Eurozone economies, and that sort of helped push the euro lower. The dollar is actually flat this morning, pretty much after another down week after the contrasting central bank meetings we saw last week. Focus, of course, now turns to tonight's Bank of Japan meeting, whether really the world's last negative rate regime will continue, or we see a pushback against these, well, and or we see a pushback against some of the market's more hawkish expectations. Gold has paired some gains on Friday, but ended the week, last week at least, higher. Still trading above $2,000, $2,022, you can see here. Interesting that for the past 6 years, gold has actually benefited from the Santa rally. So that's one that unfolds sort of late December into year end. Okay, just on stocks quickly, we'll run through some of the technicals. You can see 7 straight weeks now of consecutive gains, bursting higher beyond that July high and also beyond the March high as well. You can see the 3rd of January. Well, that's on the week, the high there, 48.18. That's where we sort of said if we could break these levels here, then we're pushing up towards that level. So we are definitely not far away, 100 points, less than 100 points away from that 48.18 level now. And really strong momentum, not overbought actually on the weekly RSI. On the daily, we are very much so. Sort of really nice example here of just range contraction, if you like, trading sideways. Small ranges that you can see, and then expectations that we generally see of range expansion. So a move in line with the dominant trend, which is the uptrend, and then a break, which we've seen then higher and consecutive weeks, as we say, of gains, consecutive days of gains as well, until Thursday's doji candle, really. You can see there on the daily at least. So that denotes some indecision. The high was 47.38, but we closed sort of in the middle of that day's range and very close to the open as well. So that's a doji candle. As I say, denotes some sort of indecision, sort of hesitancy, balance between buyers and sellers pretty equal. So yeah, interesting to see where we go from here. As I say, 48.18 is the upside target for sure, which you can see here on the monthly. Otherwise, if we do pull back, then probably these levels here, which are the cycle highs from March and obviously July, 46.37 and then 46.07. Some support we should probably see on those levels. The Nasdaq, similar. If we go to the weekly, you can see that really strong week last week. Impressive after those three sort of smaller weeks, but still up weeks, and then similarly 7 straight weeks of gains. We're pushing now. In fact, I should take some of these levels off because they're old. You can see the 15.932 that we had highlighted earlier, and that strong sort of oscillate, trading around that, trading sideways, and then the burst higher. And we're now up to where are we? Well, 16,623 close, and the high is 16,764 from November 2021. Let's just double check that. Yeah, these are all-time highs though. So that does look positive after breaking that 15,932, and that should be support on the downside. Similarly, the Dow, all that hit a record high. You probably read the headlines and closed. You can see on the week very close to its highs. A really strong positive momentum, bullish momentum there. We are overbought quite a lot, quite severely, really, on the daily RSI. So potentially expect some correction at least. You can see that high from back in January last year at 36,952. So that should be some support if we do get a slight correction. But really strong again, consecutive weeks of gains. And yeah, we've sort of looked at sort of big round numbers really if we break into new all-time highs. So that's the Dow and stocks. Okay, let's move on now to firstly to last week's Fed meeting. Of course, here's a review, so a sort of infographic review, if you like, which I've updated really with some of the key numbers from the meeting. Of course, we had those really important dot plots that we highlighted that the market would be focusing on, as well as some of the economic projections, fresh economic projections from the FOMC members. Of course, the Fed kept rates unchanged as widely expected, but really the decision was accompanied around clear dovish signals, and that was quite a shock, quite a surprise really to markets. It softened its guidance initially, the Fed, in its statement, whereby it stated that in determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. But it was that word "any" which sort of got the dovish bells ringing, if you like. The Fed also stated inflation has eased over the past year, but remains elevated, while maintaining its language that tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Which essentially acknowledges this slowing growth and cooling inflation sort of environment. That was the statement. As I said here, 4th consecutive meeting now, so certainly rates have peaked. And really then we saw in the dot plots, well, the dot plot projection for the Fed funds rate in 2024, that was lowered by 50 basis points to 4.6%. I've got it on here. Previously, that was at 5.1%, and analysts sort of had a consensus around 4.9%. So that essentially is 25 basis point rate cuts seen next year, which was, of course, lower than what was expected, as I've said. Then 2025, that was lowered to 3.6%. Previously, that was 3.9%. and the expectation actually was 3.6%. And then 2026 dot plots. So this is for interest rate expectations. Again, projections 2026 kept at 2.9%. Previous was similar, that number, as I said. And the longer run as well was kept at 2.5%. And that was slightly surprising because there was has been much chatter. I talked about it as well, actually, on CNBC a couple of months ago, just about the R rates potentially being higher over the longer term. But at this meeting, at least the longer run view was that 2.5% was correct. They also presented their inflation forecasts. That is, remember, core PCE, so not CPI. They fell to, I've got it here, from 3.7% to 3.2%. And then next year, that was reduced to 2.4% from 2.6%. Furthermore, the projection suggested that there is now really a clearer consensus for upcoming rate cuts among Fed participants. We also had that jobless rate there that you can see. Sorry, I'll get to that shortly. But the jobless rate there, just bear with me 1 second. That was unchanged through 2024. GDP expectations for GDP just a tick lower from 1.5%. Then we had the Q&A, so that shock from the dot plots being lower than expected for next year, and then the Q&A. Again, we kind of thought that he would, Powell, certainly Fed Chair Powell, would push back against, and he has done this previously, against the sort of message from the dot plots and summary of economic projections. But the surprise, the shock again, was that he did little to push back against that recent easing. Well, he did little to push back against rate expectations. He did little to push back against the recent easing in financial conditions, which is what we've been talking about for some time. Powell basically reiterated that policy is well into restrictive territory, and the full effects of tightening not yet felt. With the Fed proceeding carefully, which is what he said has said previously. He said the Fed believes the policy rate is at or near its peak and is prepared, as is always his sort of strapline, prepared to tighten policy if appropriate, while it will keep policy restrictive until the Fed is confident on the path to 2% inflation. There was some focus on whether rates are high enough. It's not likely that, but it's not likely that the Fed will hike further. And really key for markets was that Powell then noted policymakers are thinking and talking about when it will be appropriate, while he stated as rate cuts begin to come into view, it is now a topic of discussion. So there was this explicit really talk about rate cuts, which most, including us, thought he would push against, and there's certainly this easing in financial conditions. He didn't do that. And he also noted that many mentioned their rate forecasts, the officials this was, and the Fed discussed the timing of rate cuts at the meeting, while there was general expectation that rate cuts will be a topic of conversation going forward. Furthermore, as well, he said the discussion on when to cut rates is still ahead, and they will decide very carefully. And he did bring in this idea that the reason you would not wait to 2% inflation to cut rates is that it would be too late and would probably overshoot, while they need to reduce restriction on the economy well before 2%, as it takes a while for policy to get into the economy. Pretty sort of simple stuff there in a way, but certainly the direction of travel is for rate cuts at some point next year, and clear dovish signals all around this meeting. Really quite a surprise. Yes, we do have this chart which just shows you actually this flip really from September, which is well, this is from the FT, the chart from September, the dark blue bar lines, if you like, on this bar chart, and then the light blue lines being December. And you can see, fascinating, even in September, one member So this is the number of members on the FOMC. One member thought that rates could go to 6% by the end of 2024. Now, a completely different setup. And one member even thinks rates go to 3.75% by the end of next year. So a complete, not that same member, because we don't see who, but yes, you can see that really does show this contrast now, and the light blue lines really are the projections from this meeting, and you can see really the majority think rates will be, of course, below 5.25% to 5.5%. The most members think rates will be at 4.5%. And that's why then we've had this median dot plot of 4.6%. But just a great way of really showing the flip, if you like, the shifting consensus we put there from September, that meeting, to this current or most recent meeting. If I just show you actually the Fed Watch tool, which is what we like to use as well. Just bear with me 1 second. You can see it here, and you can just see, if you like, now where we are currently. Yes, really this meeting, in summary, though, a strong signal, Fed preparing for rate cuts when warranted by the data. The first rate cut is now seen in March. Really, that's a base case for markets. And if you can see here, yeah, 67.5% chance of a 25 basis point cut, even a 7.4% chance of a 50 basis point cut. So over 70% chance of a rate cut at the March meeting. That's kind of base case now, and 70% really is generally the level that the Fed look at to not want to shock markets. So we're just above that now for a March rate cut. And then going forward, well, the other signals, obviously, that sparked this rally in bond markets, really sparked risk-on sentiment after the Fed meeting. In fact, the 2-year Treasury yield, that dropped by some 10 basis points on the announcement, with the rally then extending through the press conference with an additional decline of 10 basis points, 20 basis points of the yields dropped, the 2-year yield this is, which really closely matched Fed funds futures, and you can see it here. And if we look at sort of 67.5% now, you can just see 28% there was only a chance of that 1 in 3, less than a 1 in 3 chance that we wouldn't get a rate cut. We would, sorry, get a rate cut a month ago. Now that's 2 in 3 that we will get a rate cut. So really massive change in expectations for this rate cut, which markets priced in before, of course, say 42% before the meeting, but now jumped up to sort of 60, 70% plus. Of course, then we got dollar falling, euro dollar moving a full figure higher on the back of these dovish signals, and Fed funds futures now pricing in around 140 basis points of cuts next year, and equities really cheering. S&P gained 1.4% actually on on the Wednesday, sorry, from flatlining really ahead of the meeting. And then, as I said, the Dow Jones, that hit a new all-time high. It's really interesting, kind of, if you think markets really have got ahead of themselves or not got ahead of themselves, because now we are pricing in quite aggressive pricing for rate cuts. It does leave kind of quite high sensitivity to the incoming data flow as well. Remember, data dependent, really still key, really. Interesting that if you look at historic Fed pivots, just on equities, for example, small caps have tended to underperform large caps after rate cuts, but it could possibly be slightly different this time due to really the low starting base point. And interesting that after this meeting, it wasn't really big tech that drive the outperformance in stock, but other yield sensitive sectors like utilities, real estate, healthcare, even banks. And then small caps had a great week, up around 5%, I think, the Russell 2000. So just watch out for that as well. As for the dollar, let's just show you. and look at the DXY chart, you can see the fall there on Wednesday during and after the Fed meeting. Went through down through the 200-day moving average of 103.50, down through that halfway point of the rally, which is at 103.46 there. So that was sort of interesting support, sharp move lower, and again follow through on the Thursday, of course, on the Bank of England and the ECB contrasting meetings to the Fed, those two pushing it back against rate cut expectations, in contrast, as I say, to the Fed. And we saw that in price action for sure with a dollar. Then breaking down through another major fib level, actually 102.54, which corresponded with the support back in November at 102.46. So we're down, dropped down below that, but then we sort of briefly mentioned this pushback against this slightly on Friday from John Williams, a Fed member, and then also we've had that from Mester as well in comments, I think. So interesting level. We got back to this 102.54 level, so 61.8 of this summer rally. So whether we this is resistance, which it should prove to be, or support, we shall see. Yes, we will probably see as well this sort of a swing between, if you like, Fed officials trying to sort of temper potentially the rate cut speculation against then, of course, the market and investors who've really seen this validation of dovish bets from the dot plot projections. As I say, data will be key, and we do get that PCE inflation data on Friday. Just double checking, it is Friday. Yes, it is Friday. But ultimately, really, the sort of the dot plot shock, if you like, should provide a sort of anchor for rates and for a dollar into the new year, which means, well, an anchor for rates or into the new year, which means the dollar probably won't rebound too substantially. Also, we note seasonals during this time of year, November, December, aren't great for the dollar as well. So, yeah, interesting. 102.54 for us. Strong resistance, really, to this move. Otherwise, then we go back to 103 sort of 50 area. But the low from last week is 101.77. So watch out for that if we do possibly roll over through this week. Okay, that's the Fed. Let's move on. Well, just before, I just should mention the data last week as well. We had hot retail sales really going against sort of the Fed, which was released after the FOMC meeting. But then just before the meeting, if you remember, we had US CPI data, inflation data, which was pretty much in line, really. I think for us, the rents were the biggest contribution to the core, but the rate of increase is seen as slowing. So going forward. Okay, that was the Fed, as I say. Let's just now check out the ECB meeting, which again, I've done hopefully a handy graphic for you guys. A review, basically. Again, this is a review because they had their new staff forecasts. ECB obviously kept their rates unchanged. That was expected at 4% for a second consecutive meeting. The statement really, so initially that reiterated that policy rates will be set at sufficiently restrictive levels for as long as necessary. But then in a slightly mildly dovish tweak, actually, it omitted the prior judgment that inflation is still expected to stay too high for too long. But then we did have these accompanying new staff forecasts where basically inflation was cut, and then growth was cut as well. So we had those forecasts in 2024 cut to 2.7% from 3.2, and then 2025 held at 1.9%. Interesting that the 2023 projections sort of seen as slightly off because the cutoff date was before the market moves, cutoff date being the 23rd, and then we had these projections. So some sort of slight differences and sort of concern at these projections because they were before the market moves. Then, of course, we had I'm just checking actually that date. Actually, yeah, it was November 23rd. Really, recent market pricing, as I say, we had falling interest rates across the board. That came after this cutoff date for those recent forecasts. So just bear that in mind. Obviously, if you're looking at these forecasts in more depth, but they do certainly justify an end to the current rate hike cycle, of course, and then really don't justify just yet this aggressive rate cuts for next year that markets have been pricing in. And then certainly during the press conference, President Lagarde, she said decisions will, of course, will be data dependent, not time dependent, but policymakers, and this is probably key, will not let their guard down. And she was very clear in stating that the Governing Council did not discuss rate cuts last week or that week, with policy set for what she said, I think, a plateau of hold. So rate cuts definitely not on the table. She also said the bank will need to see more evidence on wage growth, given current data shows that wages are not declining. So that was probably, the key sort of comments from the press conference. Questioned on the balance sheet, actually, which for some of you might be looking at. She noted that there were still differing views on the PEP, so that's the emergency bond buying program. Still differing views on that, whereby some governors wanted different tapering earlier or later. So nothing on that just yet, which could impact markets going forward. We've got in here then market pricing sort of moving slightly in a hawkish direction. March hikes now seen at, March cuts now seen at around a 60% chance versus 80% chance previously before the announcement, and then around sort of 145 basis points of cut seen by the end of the year versus around 160 before the meeting. Interesting, actually. Yep. So that's where we are currently, just around that, maybe a little bit less with the pushback. But yes, definitely in contrast to the Fed meeting, of course. And it's interesting. We do have many of you, any of you who do watch these meetings, we always get sort of sources after the meeting, and they were quoted, I think, on Friday yes, after the meeting, basically Bloomberg sources suggesting the ECB is largely united on forecasting rate cuts later than what markets are expecting. And the sources also added, actually, that officials do not expect to revise their stance before March, which is then when we get the next update on the outlook for growth and inflation. So really could be this stance really interesting until those fresh staff forecasts. Okay, if we just look at euro dollar, actually, which is where we will go to next, which is this chart shortly that I'll show you here. We did have this chart actually on our daily commentary that we do publish on the website. So hopefully you guys are checking that out as well. But interesting, yes, I should mention Eurozone PMI data as well was out on Friday for December. Really weak, actually. Manufacturing and services output in France and Germany, that fell more than expected, and then that drove really the disappointing Eurozone data. The manufacturing actually held at 44.2, so well below that 50 boom bust line, but that was versus expectations for a modest gain, while the service sector PMI eased again to 48.1 from 48.7. And a rise to 49 was actually expected. So that pushed then the composite down to 46.7 from 47.9. So we did see that fall on Friday. That sort of not helped, but in Eurodollar at least pushed down by the weak PMI data, and then by those Fed comments as well by John Williams, pushing back against Fed rate cuts. So you can see really on Eurodollar, should probably take these channels out, but they're just showing you examples of nice series of higher highs, higher lows, and then that down trend, obviously, through the summer, series of lower highs, lower lows. But you can see really resistance now is certainly around 110 for sure in euro dollar, 110.17, the November high, but we struggled last week then to push above it in any certain way. And we just dropped now towards 109. Next level for us, probably the halfway point, 108.62 of the summer rally. Then you've got the 200-day moving average just below here at 108.29. And then the upside, well, 110 pretty much you can see here. And you can see that sort of candle with the sort of pop higher, but then a strong close, but sorry, not a strong close, but up from the lows certainly, but certainly off those highs at 110.09. Excuse me. Okay, that's euro dollar. Excuse me. That you can see here. Okay, let's now move to the Bank of England, which again, excuse me, which also kept rates unchanged, of course. So that was for a third meeting. I haven't got an infographic here because there weren't any new, there wasn't any new, it wasn't a monetary policy report. But yes, they cut rates unchanged for a third consecutive meeting. Same vote as previously, 6-3. So hawkish dissent from, again, Green, Haskell and Mann. There was speculation possibly, but one of those could change with the falling inflation numbers that we have seen, but they didn't. Still 6-3, so hawkish signal there in a way. And then the decision really to stand pat on rates was based on the judgment that although some of the news in key data had been to the downside since the last meeting, economic developments really have been relatively limited overall. And probably the key takeaway from the release was really the decision to maintain the phrase that policy will need to be restricted for an extended period of time. There had been, again, some speculation, possibly around a softening of that language, but we didn't see it. So certainly a pushback in rate cut expectations. And then it did also continue to say that it remains a case that further tightening would be required if there were evidence of more persistent inflation pressures. And then we did have other language, actually, which also leans sort of hawkishly. It was too early to conclude that services price inflation and pay growth were on a firmly downward path. And remember, we've been highlighting those numbers as key numbers for the Bank of England, and they still see those as well, elevated and not turning down or not on that, downtrend, if you like. So that's services price inflation and wage growth. Interesting as well, the MPC judged that, if you remember, in the November fiscal plan by the government, the autumn statement, that additional fiscal stimulus will boost GDP by around 0.25%, 0.25% in the coming years. So again, the MPC have taken that into account, and really pricing shifted hawkishly actually from sort of 115 basis points of cuts across 2024 to down towards 100 basis points of cuts. The first one then pushed back to June from May, from before the meeting. I think probabilities around 80%. With the March cut falling to less than 30% now. For cable, well, just before we get to cable, actually, in fact, I probably should go to, so that was a Bank of England meeting, probably the most pushback against dovish expectations amongst the central banks. And we did get that push higher, you could see in cable, in the sterling against the dollar, two sort of fresh cycle highs, at least at 127.94, but then we had that turnaround, of course, on Friday. Just before we get to that, I will get into, that was Bank of England, but of course we do get UK CPI then moving on to this week, which is important data for the Bank of England. I've just got an infographic here of the key numbers. Might be slightly less importance to this, of course, because of or post the MPC meeting, the Bank of England meeting, of course. But anyway, still important data, potentially near term for price action. Headline expected at 4.4, so that's cooling from 4.6. And just remember that comes from that 6.7 fall, well, 6.7 to 4.6 reading last time. That was all down, of course, to the big drop in energy household bills from last year, 25% increase. And that's now dropped out of the annual comparison. So base effects really seeing then that fall 6.7 to 6.4 previously, and now we should get a slight a much smaller decline, but still a decline to 4.4% for the headline this time around. Food and energy price inflation will probably contribute to declines, with scope for good prices to keep easing. But certainly declines will not be uniform, I think, is what key or UK economists think. We also get the core, of course, that will fall to 5.7 from 6.1%. And then that all-important services inflation, that's expected to fall as well to so below the MPC forecast of 6.9% to 6.6%. So that'll be a key number to look out for, as we've mentioned. Policy perspective, as we sort of talked about, MPC, the Bank of England, really focused on maintaining guidance, with policy needing to be restricted for that extended period, as we just said. This release then, inflation release, probably have little sway, possibly over the immediate rate path, but certainly if we do get modest fluctuations, we could get modest fluctuations, around that current sort of pricing of rate cuts, May rate cut seen as most likely, with, yes, around 114, 112 basis points of cuts by year end. So potentially that will loosen, that could increase further. If we get so more rate cuts, if we get a softer report, or a reining in of those rate cuts, if this is more sticky than thought, that will then help, of course, the pound. Also, I mentioned we do get, I should have said US inflation data. I should have said that when we're looking at the DXY. But yes, analysts expect that to cool further in November after similar outcomes seen in the CPI and PPI data. Interesting, I think, the Fed's watcher, if you like, the Wall Street Journal's Nick Timiraos, he has said core PCE inflation projected to have been a very mild 0.06% in November. That's on the month, remember, and that could see the end of the annual reading fall to 3.1% in November from 3.5% in October, and that would imply actually a 6-month annualized rate would have eased to 1.9%, so below the Fed's 2% price goal. So interesting there. And if I just, here's the chart for the UK CPI, still above that 2% target. That's why this persistent, why they talk about persistent inflation and keeping rates extended high for an extended period. And then we've got, yes, the core PCE, the US number, and you can see the chart there still continuing to fall. And potentially some of these numbers will be looked at. This annualized 6-month annualized rate now below the 2% target of the Fed. Okay, just before we wrap up, actually, we'll just obviously look at dollar yen, which will be in focus with the Bank of Japan meeting. That meeting has started, of course, 2-day meeting, and then the announcement is due early in the morning tomorrow, London, UK time at least. Bank expected to keep its policy settings at unchanged at this meeting, but certainly expectations have been choppy over the last few weeks, and that came after Governor Ueda's comments, who said the handling of monetary policy would get tougher from the end of the year. And that really fueled speculation about possibly a December tweak by the Bank of Japan. The yen rallied really quite sharply. And you can see that here. Probably that was then actually, But thereafter, really, we've seen a number of sources say really it was not the intention of the governor to signal anything about the timing of a policy change. We've had multiple sources actually basically clarifying that the Bank of Japan um, wants to see, well, they have said they see little need to end negative rates in December, intend to come to a decision based on the data up to the last minute, but they view the cost of waiting for more data as really not that high. They lack really proof of sustainable inflation, and they've also not yet seen sufficient evidence of wage growth, which would support sustainable inflation as well. Yes, basically, all the sources have said the move to tweaking rate hike expectations. Really, that's still very premature. Investors now actively betting on the end of negative rates. Really, have pushed that out really to the new year. And then that means really it's all around the language at the Bank of Japan meeting overnight tonight, which will be key for sort of yen performance. What could Governor Ueda do? Well, he has the option of keeping the message broadly unchanged, and that would, of course, disappoint markets' hawkish expectations. And that would hurt the yen, or potentially offer possible hints about the state of the discussion on a rate hike, and then suggest some sort of timing. Will be interesting. Bank of Japan have sort of surprised before, but then also disappointed. So certainly the good performance of the yen recently has, seen global rates, on the back of global rates declining. That's probably taken some pressure off the Bank of Japan, but the data is really sort of proving inconsistent with still this ultra dovish stance kept by the Bank of Japan. There is the factors, of course, about spring labour talks and whether the Bank of Japan waits till any tweaks, which is in sort of March time, before then making a sort of more concerted effort to exit negative interest rate policy in the first quarter. I think the latest Reuters poll, shows that 21% of economists think the BOJ will begin to unwind ultra loose policy in January, actually, while 84 expect the end of NIRP, so negative interest rate policy, sometime in 2024. And that's sort of against, say, 54% in the October poll. Interesting meeting coming up. Certainly, possibly too early for a real change in the dovish message, and that could increase a possible downward correction in the yen. So you see dollar yen moving higher. Of course, then the chances of a hike in January when new economic projections are released, certainly not non-negligible, and will depend, of course, on data going forward. Any hawkish surprise in communication, well, that will then push dollar yen closer towards 140, and you got last week's low at 140.94 then before the sort of 140 level. And then, as I say, any sort of unchanged message and complete non-comment on the rate hike expectations, or at least change in policy, then that could potentially push above the 200-day moving average. That's a 142.55 you see there, and then we could just get back up to sort of 145, 146 level or so. Well, 144, sorry, which is probably, a nice sort of level of resistance that you saw there in June, and then support in sort of August. So that's the Bank of Japan meeting. And we do get, just to note, Tokyo CPI actually this week, which is generally a precursor for the nationwide metric. That is released, I think, on Thursday. So just watch out for that after, of course, the meeting. Okay, I will wrap it up there. Hopefully, that's been useful to you guys. I don't see any questions actually in the chat. So, please do follow us on social media and also on the website. We post a daily comment. Still quite a few risk events ahead on the calendar for this week. So watch out for those, and we'll speak to you soon. Take care.